Something is happening right now that isn't being reported in the financial media. It's not the stock market crash. It's not the sudden spike in oil prices. It's not the Fed's interest rate decision either, though all of these are just as real as they are significant. It's something quieter, something more deliberate. It's something that only becomes visible when you stop chasing the headlines and start tracking where the money is actually flowing. The world's smartest institutional capital, central banks, sovereign wealth funds, and the family wealth management firms of billionaires who have weathered every crisis of the past 50 years, is steadily and gradually withdrawing from the traditional banking and brokerage system. Right now, in March 2026, as you watch the S&P index turn red and the balance of your 401k account shift in a direction that triggers a very specific kind of anxiety. They aren't getting involved in the cryptocurrency market. They aren't getting involved in speculative investments either. Nor are they getting involved in any matters that require a lawyer, a shell company, or conversations you'd be hesitant to discuss openly. Instead, they're focusing on 3 specific investment channels that are fully compliant with the law, regulated at the federal level, government approved, and accessible to any American with an internet connection and a few $100s. And here's what will stop you in your tracks. The reason you've never heard of these strategies isn't because they're unknown. It's not because they're complicated. And it's not just because they're only accessible to people with $1,000,000 accounts. The reason is that when you use these strategies, every financial institution standing between you and these strategies makes exactly $0. Your bank won't tell you about this. Your financial advisor won't mention it. The financial media won't run a headline about it, because the system that profits from your deposits, your fees, and your inaction has no reason to offer you a way out. This video is that way out. I'll show you exactly how each strategy works, what it costs, where you can access it today, and why the convergence of the Iran war, the oil shock, the resurgence of inflation, and the Federal Reserve's complete paralysis has created the conditions that make these strategies so crucial. But first, and this is very important, you need to understand exactly what I mean when I say outside the system, because I'm not talking about anything illegal here, not tax evasion. It's not about offshore accounts. It's not about assets purchased from any source requiring anonymity. That can't be traced. Every strategy in this video has been approved by the United States government. It is regulated by federal agencies. It is used every day in the world's most advanced wealth protection operations. When I say off-system, I'm referring to a structural situation. When your money sits in a traditional bank savings account, the bank lends that money to other customers in need of credit. Your deposit is, technically, a loan you've extended to the bank. In the event of a bank failure, you must rely on FDIC insurance to get your money back. While FDIC insurance is reliable, it covers only $250,000 per depositor per institution. When your money is held in a brokerage account invested in stocks, it is exposed to market risk, margin calls, systematic sell-offs triggered by algorithms, and any headline that moves the market on any given day. You've seen what's happened over the past 3 weeks. The S&P 500 fell to 6,632 points, reaching its lowest level of 2026. The Nasdaq, meanwhile, dropped below its 200-day moving average. Goldman Sachs confirmed that algorithmic funds were selling off in every scenario, and 40 million Americans with margin accounts are facing the risk of forced liquidation. The 3 strategies I'm about to present shift a portion of your wealth into instruments that no bank can lend against. No algorithm can sell this. No brokerage firm can issue a margin call against it. And no market crash can reduce its face value. Let me share the numbers with you. $4,999.88. That was gold's closing price last Monday. It has risen 19% since January 1st. It outperformed the S&P 500, Nasdaq, bonds, real estate, and cash, all at the same time. Central bank gold purchases in 2022 totaled 1,082 tons, then 1,037 tons in 2023, then 1,045 tons in 2024, and it exceeded 1,000 tons. For 3 consecutive years, the average annual figure for the decade prior to 2022 was 400 to 500 tons. They more than doubled that rate, 0.39%. The FDIC's National Average Savings Account interest rate, as of March 16, 2026, exactly 39 cents per $100 reach per year. 4.03%. The interest rate the U.S. Treasury is currently paying on a product most Americans have never even heard of. 40%. The U.S. dollar's current share of global foreign exchange reserves, the lowest level since 1994. Gold's share has risen to approximately 30%, the highest level since 1991. U.S. dollar reserves have declined by 12% on an annual basis. Gold reserves, on the other hand, have increased by an average of 40%. These figures are not isolated events. They are all indicators of the same underlying structural shift. This is the framework that ties everything together. Essentially, there are two distinct types of wealth: currency-based wealth, assets whose value exists only if an institution guarantees it, your bank account, your assets held with brokerage firms, your bond portfolio. Each of these requires a counterparty to fulfill its function, to ensure your wealth remains intact. Counterparty independent wealth, assets whose value exists due to physical assets. Direct government bonds held in your own name, physical gold, physical silver, under normal circumstances. This distinction seems like a theoretical matter. Both types of assets appear on screens as mere numbers. Both gain nominal value. The difference between them seems insignificant, just as the material a boat is made of seems unimportant when the water is calm. But when the waters rise and the waves crash, when a bank is under pressure, when algorithms trigger a series of forced sales, when inflation hovers at 3%, while your savings account yields 0.39% interest, suddenly, the only thing that matters is the material. Since 2022, the smartest investors have been converting currency-linked wealth into counterparty-independent wealth in a methodical and systematic manner, without panicking. This system consists of three components. First component, physical precious metals. There is no counterparty risk. It is zero. The second component, treasurydirect.gov. Government bonds purchased directly with no intermediaries. The third component, a self-directed precious metals IRA account. Physical gold outside the banking system. It appreciates tax-free in a Roth account. Each operates independently on its own. When combined, they form a portfolio with no single point of failure. Essentially, what makes physical gold important isn't where the price is headed. When you own physical gold, for example, a 1-ounce American Eagle worth about $500 or a 1/10-ounce coin, you hold an asset with zero counterparty risk. A stock represents a claim on a company's future earnings. A bond is simply a promise to repay you. A bank deposit, on the other hand, is legally an unsecured loan to the bank. The physical gold in your possession, however, is completely free from all such dependencies. Even if all banks were to go bankrupt tomorrow, your gold would remain in your possession, tangible and secure. Even if the S&P 500 index drops by 50%, your gold remains in the vault, waiting. The figures from the World Gold Council are worth noting. 2022, 1,082 tons purchased by central banks. 2023, 1,037 tons. 2024, 1,045 tons. Monthly average through the first months of 2026, approximately 60 tons, more than 3 times the pre-2022 pace. The People's Bank of China added 122 tons to its gold reserves in January 2026 alone. Gold has overtaken the euro to become the world's second largest reserve asset. Central banks in state are converting this money into physical gold at a rate 3 times higher than 4 years ago. They are not engaging in restructuring or speculation. This is not a footnote. This is a structural realignment of the global monetary order, and it is happening in real time, right before everyone's eyes. Moreover, it is being documented by the very institutions driving it. The dollar's share of global foreign exchange reserves has fallen to approximately 40%, the lowest level since 1994. Gold's share, meanwhile, has risen to about 30%. The highest level since 1991. Looking at the situation in dollar terms, U.S. dollar reserves have decreased by nearly 12% compared to last year. Gold reserves, on the other hand, have increased by approximately 40%. This is not a fluctuation, this is a redistribution. Now, I'd like to address the objection I imagine is forming in your mind right now, because this is a legitimate objection. and deserves a direct response. You might be thinking, gold enthusiasts have been predicting the dollar's collapse, and for 40 years. Most of those predictions, Beta, turned out to be wrong. Why is this time different? Here is my honest answer. I don't want you to believe that the dollar is about to collapse. What I want you to do is pay attention to what the dollar's institutional defenders, the central banks holding dollars, the government funds dependent on the dollar, are actually doing with their reserves. Not what they say, but what they do. And what they're doing is reducing their dollar holdings while purchasing physical gold at 3 times the historical rate. You can't argue with the balance sheet. My second objection is this: I can't afford to buy gold at $5,000 per ounce. This strategy is reserved for the wealthy. I want to make this clear. This objection is the reason why most people who need this information never take action. The U.S. Mint produces American Eagle gold coins in 4 different sizes: 1 ounce, half an ounce, a quarter ounce, a tenth of an ounce, at current prices. A 10th ounce coin costs just under $500, plus a small dealer's commission. American Silver Eagle coins range in price from $32 to $35. Treasury direct accounts can be opened with as little as $25. I-bonds can be purchased in any amount, up to $10,000 per year. These strategies were designed to be accessible. What was missing wasn't access, it was information. Strategy number 1, physical precious metals, direct ownership of gold and silver held outside of any financial institution. If you own physical gold, for example, a 10-ounce American Eagle gold coin, a silver coin, or a small bar sourced from a COMEX-approved refinery, you own a commodity with zero counterparty risk. No institution's fulfillment of a commitment is required for your gold to appreciate in value. It differs from stocks, which represent a claim to future earnings. It differs from bonds, which promise a return. It differs from a bank deposit, which is an unsecured loan legally granted to the bank. Physical gold is the asset itself. Even if the bank goes bankrupt, your gold does not vanish. Even if the brokerage firm goes bankrupt, your gold remains unaffected. Even if the stock market loses 50% of its value, your gold remains physically intact and is not affected at all. Purchase from sellers with at least 10 years of experience in the field. Look for accreditations from reputable industry organizations. Transparent pricing with premiums clearly stated. Above the spot price, please, is non-negotiable. Upon purchase, Grip will take physical delivery. Store it in a safe at home, in a rental safe deposit box offered by a bank, or in a private safe deposit box. This is the key difference from gold ETFs, which represent a paper claim on metal held by a fund company. A fund company with a custodian that could freeze your account, or a manager facing redemption pressure, is essentially a paper-based structure. None of these layers exist with the physical metal in your possession. The metal is yours, period. An honest caveat: physical gold cannot be converted into cash instantly. Converting it to cash takes hours or days. For this reason, it should not constitute your entire wealth, but rather its foundation, between 5 and 15% of your total wealth. 11 Labs Okuma Formati Strategy, IKI, Treasury, Direct Nocta, Govibi, Purchase, U.S. Treasury Securities, directly from the U.S. Department of the Treasury, without any barriers, such as banks, brokerage firms, commissions, or annual management fees. Treasury Direct to Pisuat is a website managed by the U.S. Department of the Treasury. Here, any U.S. citizen or resident can open a free account and purchase government bonds directly from the source. The key product of this strategy is the Series 1 Savings Bond. I-bonds currently pay a compound interest rate of 4.03%. This rate includes a fixed interest rate of 0.90%. That remains unchanged throughout the bond's term, as well as a variable inflation component of 3.12% that is reset every 6 months based on changes in the Consumer Price Index, CPI. Compare this to the national average bank savings interest rate of 0.39%. This is a tenfold difference, and it's not a rounding error. Let me explain this using actual numbers. A retiree with a national average bank interest rate of 0.39% earns $390 a year on a $100,000 lump sum. When the I-bond interest rate is 4.03%, that same money, earns nearly $4,030 a year. The difference is $3,640 every year. All you have to do is transfer the money from a bank savings account to a free government website. That's what makes March 2026 particularly valuable. In terms of I-bonds, the current inflation component reflects data from before the full impact of the Iran war oil shock hit consumers' pockets. When the interest rate is recalculated, in May 2026, CPI data from March through September will be taken into account. These figures will include the full downward momentum of oil priced at $99 per barrel. If inflation remains around 4 to 5% annually, the compound I-bond interest rate could automatically rise to 5 or 6%. You won't need to take any action on your part. This is the structural protection that no other product in this video offers. The face value of I-bonds never decreases. A stock can lose half its value. A standard bond loses value when interest rates rise. Real estate can lose value during economic downturns. However, the face value of an I-bond never falls below the purchase price. Even in the event of deflation, the interest rate drops to zero. It never goes negative. Your principal is mathematically guaranteed by the United States government through Treasury Direct. The purchase limit per person per calendar year is $10,000. A married couple can purchase up to $20,000. Additionally, if you are filing a tax return for a refund, you can redirect up to $5,000 of that refund into paper I-bonds, thereby increasing your individual annual total to $15,000. There is no account opening fee. There is no purchase fee. There is no annual management fee. The only reason most Americans are unaware of this is that no financial institution can profit by explaining it to them. Strategy 3, a self-directed precious metals IRA. Here, the first two strategies come together to form the most powerful and tax-advantaged wealth preservation method available under current laws. A self-directed IRA is a personal retirement account that the IRS permits to hold physical precious metals, American gold eagles, American silver eagles, Canadian gold maple leaves, and bullion meeting minimum purity requirements. Here's how it works. You set up a self-directed IRA account with a storage facility specializing in precious metals. You transfer funds into this account directly through contributions, up to $7,000 per year if you're under 50, or up to $8,000 if you're 50 or older, or by rolling over funds from an existing 401k, 403b, or traditional IRA account. This rollover it is not subject to the annual contribution limit. And here's a very important point. A direct transfer between trustees is not a taxable transaction. You can convert $200,000 from an existing retirement account into physical gold and won't have to pay a single cent in transfer fees. Now let's turn to the Roth section. This is where the numbers look very different. If you convert to a self-directed Roth IRA, the gains on these assets are not subject to tax permanently. To illustrate, let's consider a retiree who transfers $200,000 from a traditional 401k account to a self-directed Roth Precious Metals IRA. They pay income tax at today's rates as a conversion cost. This is a deliberate calculation because if you believe tax rates will rise as Congress is forced to address the $38 trillion national debt locking in today's rates holds real value. The custodian purchases 40 ounces of American Eagle gold coins at approximately $5,000 per ounce. These coins are deposited into an IRS-approved vault. If gold reaches Goldman's target of $5,400, the value of the 40 ounces becomes $216,000, a completely tax-free profit of $16,000. If gold reaches J.P. Morgan's $6,000 scenario, the value of the 40 ounces becomes $240,000, a profit of $40,000, zero tax. I'll be honest with you about the costs, because this strategy involves various expenses, and you have a right to know them before making a decision. Self-directed IRA custodians charge an annual administrative fee. This amount typically ranges from $100 to $300. Custodians also charge a custody fee, usually between $150 and $300 per year, depending on the value of the assets held. The metals themselves are also subject to a seller's premium above the spot price, typically 3% to 8% for coins and 1% to 3% for bullion. These are the actual costs. You need to factor them in. But the key point to consider is this. A typical investment fund charges an annual fee of 0.5% to 1% of your total balance on a $200,000 investment. This amounts to $1,000 to $2,000 per year, and this amount accumulates against you without you even realizing it. The flat fee structure of a self-directed precious metals IRA is significantly cheaper for larger balances, and unlike mutual funds, does not increase as your wealth grows. Now let me show you how these three strategies come together within a single household framework. A 62-year-old retiree with $300,000 in savings and retirement accounts takes 4 steps. First, they transfer $50,000 from a regular savings account to a high-yield savings account. This account is fully insured by the FDIC, accessible within 2 business days, and yields 10 to 13 times more than the old account. This serves as the liquid reserve layer for emergencies. Second, a new $10,000 I-bonds account is opened on Treasury Direct at a 4.03% interest rate. The person's spouse does the same. These are $20,000 in inflation-protected principal guaranteed government bonds. If an oil shock drives up inflation, they automatically adjust. Third, $200,000 is transferred from an existing 401k account to a self-directed Roth IRA account for precious metals. Income tax is paid based on current rates during the conversion. 40 ounces of American Eagle gold coins are purchased and sent to an IRS-approved vault. From that point on, every dollar of appreciation is permanently tax-free. Fourth step, $30,000 remains in the no single point of failure can bring down this portfolio. A bank's bankruptcy affects neither gold nor treasury bonds. A market crash does not affect I-bonds or physical metals. A surge in inflation benefits both I-bonds and gold simultaneously. And a currency crisis, the kind central banks have structurally prepared for by purchasing 3 times their historical average of gold, is absorbed by the largest single allocation in the only asset that has served as money for 5,000 years. I'd like to return briefly to Carol, the retired Ohio teacher mentioned at the beginning of this article. By traditional standards, she did nothing wrong. She saved money for 35 years. She invested her money where her bank and advisor directed her. She followed the rules. And because she trusted the system, which wasn't designed to protect her savings, she watched $34,000 vanish in 11 days. The system she trusted was designed to use money. I'm not saying this to annoy you. My point is that the tools to protect Carol were available, and they were legal and approved by the state from the beginning and accessible. Treasury Direct, physical metals, IRAs under your own management, accessible to every citizen with a computer and a social security number. These tools were always there. The information wasn't. Now you have both. I-bonds at 4.03% interest are available until April 30th. Gold is trading below its recent all-time high of $5,500, offering a viable entry point. The Roth conversion window is open with today's tax rates that could change as Congress moves on $38 trillion of national debt. These windows will close, not all at once, slowly, then suddenly. Institutions that are moving hundreds of tons of gold reserves aren't waiting for a more opportune moment. They're acting now because they understand that the timing of positioning yourself in currency transitions isn't a trivial variable. This is the whole game. If this video has provided you with information that your bank or financial advisor would never voluntarily share, take action right now. Share this meeting with someone. Share it with a friend who's a retiree, still keeping their life savings in a bank account. That pays just 0.39% interest. Share it with someone nearing retirement who's never been informed that physical gold held in a Roth IRA account can appreciate in value completely tax-free. Share this with someone who pays an annual fee to a financial advisor for no reason when they could actually purchase the same treasury bonds for free themselves. And subscribe, because every week, we provide analysis that translates the specific moves made by the best informed investors into steps any American can take, not so you'll fear the future, but because you have the right to understand things clearly enough to make your own decisions. The exit strategy isn't about leaving America. It's about leaving a system designed to turn your deposits, your wages, and your lack of knowledge into profit. The three strategies in this video are the same ones: central banks, sovereign wealth funds, and the world's most